now, we have housing starts month on month disappointing to the downside, coming in at 2.6%. You also have building permits coming in down 2.5%. So a miss on both. The 10-year yield holding steady at 2.35%. If I take a look at the dollar index, still steady down by 0.4%. But another sort of read to potential risk in the economy as housing has really held up over the longer term, David.
Yeah, so let's talk now about what those data really mean. To help us interpret them, we're joined by Rich Clarida of Pimco and Peter Borish of Quad Group. So first of all, how important are housing data to the GDP growth numbers? Because I know last year, for example, only 2/10 of the GDP was attributable to housing data.
Yeah, now, obviously, but I think housing is important for several reasons. There's the direct effect, and it's also obviously correlated with production of appliances and other parts of the economy. So it's a very important indicator, and obviously this was a number that was soft. And again, another example of hard data coming in below the soft data that Alex pointed to a moment ago.
And there's some good reasons for it.
Yeah.
Because, I mean, prices have gone up. Right. It's not as affordable. Financing is getting somewhat tighter. Yeah. So there's some concern about affordability for the typical American consumer.
I think so, although housing is still, if you can come up with a down payment and you've got a job, housing is still very affordable. In most parts of the country, you move away from the urban areas, certainly.
But Peter, is this just like weather? Can we just blame weather for a couple more months? Is it too much to make about another data surprise to the downside?
Well, it's one data point. I'm a simple person. I'm going to look at Home Depot opening in record high ground today because of strong housing. If it opens higher, new high, and then closes lower on the day, I'm going to trust people that are actually voting with their money rather than, you know, permits and different things. So that's something that I'm going to look at to see if this data is real.
But what it does wind up showing is part of what drove the S&P rally was that economic data surprises were surprising to the upside. Yeah. So take a look at the Bloomberg here. The white line is the Bloomberg Eco U.S. Surprise Index that started to roll over in mid-April, yet the S&P has continued to grind higher. Does this gap need to resolve itself, Rich?
Well, I think it does, and I think the resolution is really going to be in Q2. We'll get the Q2 data in July, and currently forecast or tracking or wishful thinking has Q2 as strong, maybe 3.5% annualized. If that number under-delivers again, then I think the markets will have to start to rethink this story about a temporary slowdown in Q1. So to some extent, I think it's too soon to tell.
To some extent, Peter, a rollover of economic surprise index makes sense, right? You start looking at the different data, then you revise your estimates, and all of a sudden the eco data is going to disappoint. But how much of a pullback can we see in the S&P from that?
Well, that is the trading question, isn't it? What's the percentages? One should always manage their expectations, considering that we haven't seen 10% pullback really since the January of 16. And I think people are going to suffer a little bit from money illusion here because the levels are so high. So the points in the decline will have them concerned. And so that may lead to a little further decline. But we're going to have to see what happens. I'm saying we're going to go 5 to 7% between now and when we get the GDP numbers. And that's going to be an indication because if growth is slowing and you look at forward PEs, that reality has to come back into play, and we could see a larger correction.
But is growth slowing?
Well, as I said, we've had a soft Q1, yes. and obviously last year came in at around 2%. Again, I think the general view is that the global economy is surprising on the upside. I think the stocks, to get to the earlier point, the stock market's really driven as much by the global economy as the U.S. There's a huge multinational presence in those indexes. So I think that's part of the divergence that Alex talks about. But again, I think it's roughly a 2% economy in the U.S. We had a soft Q1. We should get some rebound in Q2.